$59.32. A single number flashing on the screen, yet a number that quietly rewrites half a century of financial history. Silver has just broken every record. Today, December 6th, 2025. But while the world fixated on the price chart, something far more intriguing unfolded in the shadows. Reports indicate that JP Morgan shifted roughly 169 million ounces of silver into their vaults, an amount approaching 9% of global supply. That is not a routine adjustment. That is a move of intent. They have been building this position since 2011. 14 years of accumulation, almost ritualistic in its patience. Quiet, careful, deliberate. And it leaves me wondering, if silver is as unimportant as so many mainstream analysts claim, why would the most influential bank in the United States treat it like a strategic asset? My theory is simple but unsettling. We may be standing inside a pattern that has repeated in every major financial crisis in recorded history. A sequence of events that begins subtly, grows quietly, and ends violently. A pattern that, as far as I can tell, has never failed. And as I watch the data unfolding in real time, I suspect that pattern is now entering its final stage. You still have a choice in how to interpret it. But the window to act, or even to understand, may be narrowing faster than most people realize. This is not financial advice. I am not a financial advisor. What follows is educational analysis based solely on information available to the public. But after months of studying historical collapses, tracing them backwards from their endpoints to their origins, I keep seeing the same four stages appear again and again. And silver, right now, seems to be standing in the fourth. The first stage is always the setup. Authorities engineer an illusion of stability, a period where everything appears orderly, rational, predictable. Prices become compressed, volatility suppressed, risk hidden under layers of regulation and promises. And beneath the surface, a colossal paper market swells, a system built not on metal but on claims to metal. In the case of silver, this began in the aftermath of the Hunt brothers saga in 1980. Regulators, shaken by the sudden surge and crash, constructed a market framework intended to control volatility. But what they created was something else entirely. A paper market that some analysts now estimate has grown to 50 times the size of the physical market. Consider the implications. Recent published data from the major commodity exchange shows open interest sitting at roughly 244% of the actual vaulted silver. That means that for every ounce of metal sitting in a vault, more than 2 ounces exist on paper. If even a fraction of those paper holders requested physical delivery at the same time, the system could strain, perhaps even crack. Throughout history, the first stage of financial failure always looks deceptively calm. Stability is the bait. Stage 2 is expansion. The divergence between paper promises and physical reality widens. Debt grows, money printing accelerates. Trust in the system becomes the glue that keeps everything functioning. But prices remain suppressed, artificially quiet. In my view, we have been living in stage 2 since 2008. In the wake of the global financial crisis, central banks around the world reportedly printed over $30 trillion combined. The United States alone added roughly $8 trillion to its balance sheet. One would expect a precious metal tied to scarcity to react explosively, but silver did not. Why? My interpretation is that each time real-world demand grew, major institutions responded not by surrendering metal, but by issuing more paper representations of metal, short contracts, derivatives, instruments designed to absorb demand without touching supply. Prices remained pinned below $30 for nearly 10 years. Yet, beneath that quiet line on the chart, forces were building. Industrial demand for silver surged. Solar panels require silver for conductivity. Electric vehicles consume significantly more silver than traditional cars. Modern infrastructure, 5G towers, artificial intelligence data centers, medical devices depends on silver's unique properties. Industry reports now suggest industrial usage represents nearly 59% of all silver consumption, a dramatic rise from around 40% just a decade earlier. Silver is no longer just a monetary metal. It is infrastructure. It is energy transition. It is technology. But mine production has not kept up. Reports show global silver production has declined approximately 7% since 2016. Analysts call this a structural deficit. For 7 consecutive years, the world has consumed more silver than it has produced. The shortfall has been filled by draining above-ground stockpiles, tapping vaults and reserves accumulated over decades. Nations such as India have reportedly imported record quantities. China has been quietly accumulating as well. Yet prices remained suppressed until only recently, which brings us to the part that fascinates me most. Since 2011, JP Morgan appears to have accumulated a staggering amount of physical silver, Some analysts estimate their total holdings at around 675 million ounces, an amount potentially representing nearly half of the world's above-ground supply in 1,000-ounce commercial bars. To put that into context, this is more than the Hunt brothers held at their peak, more than Berkshire Hathaway ever held, more than the official reserves of many countries. Why would a bank known for its precision and its power build a position of this magnitude? Historical records offer a hint. When J.P. Morgan acquired Bear Stearns in 2008, they inherited a massive short position in silver. For years, they were reportedly trapped on the wrong side of the trade. Then, according to market observers, they reversed course. They covered their shorts. And then they accumulated. Quietly, aggressively, methodically. Today, exchange filings suggest they hold around 169 million ounces in their commodity exchange vaults alone, perhaps representing 40% of total eligible inventories. To me, the gap between paper and physical silver has never been wider. And that leads us to stage 3, the break. In every historical cycle, this is the moment something fails, an unexpected event, a technical glitch, a liquidity freeze, a geopolitical shock, something that forces people to question whether the paper claims they hold can truly be redeemed for real assets. I believe we are entering this stage now. On the 28th of November, 2025, the major derivatives exchange reportedly suffered a 10-hour outage said to be caused by a cooling system failure. During that pause in trading, silver prices surged to around $56.72, an all-time high at that moment. When the system came back online, the bid-ask spread widened dramatically. Over $1. That is not normal. That is what financial stress looks like. That is what happens when a market built on layered claims suddenly faces the question, who actually holds the metal? And then came another signal. According to filings, J.P. Morgan reclassified around 13.4 million ounces from registered to eligible. Registered silver is deliverable against futures contracts. Eligible silver is simply stored, it is not available for delivery. In effect, J.P. Morgan reportedly removed nearly 9% of deliverable silver from the system at the very moment when demand was peaking. It is hard not to interpret that as preparation. Meanwhile, silver lease rates reportedly skyrocketed to around 30% annualized in October. That level of interest suggests desperation, a scramble for real metal. Borrowers willing to pay 30% per year are not trading for convenience. They are racing against scarcity. And now, today, silver stands at $59. Up roughly 98% year-to-date, its strongest performance since 1980. This is how Stage 4 begins. The stage I call eruption. Prices rise violently. Short sellers are forced to cover. Institutions positioned early become the winners of a generational transfer, and the rest of the world wakes up too late. History offers us a mirror, and perhaps the clearest reflection comes from Texas, 1979. Two brothers, Nelson and William Hunt, studied a world drowning in inflation, where the buying power of the dollar eroded faster than wages could keep up, and they saw in silver a lifeline. At around $6 per ounce, they believed they had identified a fundamental imbalance. Demand growing, production stagnating, and distrust in fiat currencies climbing. So they acted. They reportedly bought around 200 million ounces, roughly one-third of the entire silver supply in the United States. By January 1980, silver soared to $49.45, an 800% rise in 18 months. It was a squeeze unlike anything modern markets had seen. Banks panicked. Exchanges intervened. Rules were rewritten overnight. New long positions were banned. Only liquidation was allowed. And on the 27th of March 1980, what is now known as Silver Thursday, the price collapsed. The Hunts were financially destroyed, but their thesis wasn't wrong. The shortage was real. The demand was real. And the price they reached was real. It simply took rewriting the rulebook to stop the pressure. And that leads to a haunting question. What if the buyers today aren't two vulnerable billionaires, but the most powerful bank in the country? A bank that understands regulatory structures. A bank that shapes markets rather than reacts to them. A bank that has learned from past mistakes, not its own mistakes, but the mistakes of those who tried to corner the market without institutional backing. We saw a similar phenomenon in 2008, though in a different market. Mortgage-backed securities collapsed when the world realized that the paper promises stitched together into those securities did not match the reality of the underlying assets. Trust evaporated almost instantly. Gold, meanwhile, surged from around $720 per ounce to over $920 by 2011, a rise of roughly 167%. When paper fails, capital scrambles toward physical certainty. It always has. And yet, the deeper problem was never solved. In the aftermath of 2008, central banks engaged in unprecedented stimulus, reportedly printing around $16 trillion globally. They purchased their own government's debt, suppressed interest rates to near zero, and expanded financial abstractions to levels no economist from the 20th century could have imagined. The system was stabilized but not healed. Instead, it became more fragile, more leveraged, more dependent on confidence. And confidence, unlike silver, cannot be audited. Now silver sits just under $60, consolidating, waiting. But consider what could happen if resistance finally breaks. Major banks once projected $38 by late 2025. That target has already been exceeded by more than $20. Other analysts predicted ranges of 36 to 39. Those have also been left behind. Some independent voices, such as Lawrence Lepard, pointed towards $75 to $90 by the end of 2026. But even those forecasts assume the paper market survives intact. They assume orderly liquidity. They assume the game remains the same. But what if it doesn't? Adjust the 1,980 peak of $49 for inflation, and you get a modern equivalent of roughly $170. And remember, that peak occurred under conditions far less strained than today. The structural deficit is deeper now. Industrial reliance is greater now. The paper market is exponentially larger now. All three pillars, supply, demand, liquidity, are under maximum tension. Silver has historically traded around a ratio of 15 to 1 relative to gold. Today, that ratio hovers around 72 to 1. When that gap eventually closes, and history suggests it always does, silver's price could theoretically reach $280 per ounce based solely on mean reversion. No conspiracies, no manipulation theories. Just a rebalancing of a ratio that has rarely stayed this distorted for long. Now, imagine what happens if holders of paper silver suddenly demand the real thing. Imagine pension funds, sovereign wealth funds, retail investors, and global industries all asking for physical metal at the same time. There may simply not be enough to go around. Not even close. This is the scenario that keeps analysts awake at night. And now, as all of this unfolds, a pivotal moment approaches. In 3 days, on December 9th and 10, the Federal Reserve meets to decide on interest rates. Current estimates put the likelihood of a rate cut at roughly 87%. If that happens, the dollar typically weakens. When the dollar weakens, gold and silver tend to surge. It has happened in almost every major policy shift since the 1,970 seconds. Today, gold sits around $4,212 per ounce, with some analysts forecasting $4,500 to $5,000 by mid-2026. Silver follows gold, but it moves faster, more violently, more explosively. In my view, the Fed meeting may be the spark. But the tinder was already laid. A structural deficit, a strained paper market, a major bank sitting on a mountain of physical metal, geopolitical uncertainty, energy pressures, rising premiums from dealers who now report delays and reduced inventories. The ingredients of a market eruption are all present. If futures contracts fail to deliver, even temporarily, physical premiums could surge to 30, 40, even 50% above spot price. We've seen this before. During the COVID panic in 2020, silver reached around $28, yet physical coins reportedly sold for around $45. That was nearly a 60% premium. Now imagine such a premium at a price of $100, or $150, or $200. It may not happen tomorrow. But it also may not take 10 years. At current rates of inventory decline, the registered supply in the major exchange vaults could fall below 50 million ounces within 6 to 12 months. It currently sits around 113 million, and if a wave of demand hits suddenly, that timeline shrinks dramatically. But here's the deeper truth. This isn't just a story about silver. Silver is the symptom. The underlying issue is the dollar itself. Since 1971, when President Richard Nixon severed the final link between the dollar and gold, the American currency has become entirely fiat, backed by confidence, by economic output, and by the shared belief that it will hold value. Yet, for 5 decades, printing has accelerated, deficits have expanded, and inflation, according to some economists, has been masked by changes in statistical methodology. Perhaps the bill is finally coming due. Gold at $4,200, silver at $59 and climbing, energy prices elevated, institutions diversifying into tangible assets. Signals scattered across the financial landscape all point to the same conclusion. Scarcity matters again. Tangibility matters again. The system is shifting back toward what can be weighed and measured. Silver may be the most undervalued scarce asset of this era. Undervalued compared to gold. Undervalued compared to industrial necessity. Undervalued compared to the scale of global money creation. When the market corrects that undervaluation, if it does, the adjustment could be historical. Remember, silver peaked at $50 in 1980. It took 45 years to break that record. 45 years of suppression, accumulation, and pressure building beneath the surface. Now the coil has finally released. The Hunt brothers were early. Not wrong. Their tragedy was timing. They fought against a system determined to stop them. But J.P. Morgan is not fighting the system. They are part of it. They understand the rules. They understand when not to move too fast. And so, while the world waits for headlines, they accumulate quietly, patiently, strategically. If silver reaches $100, then $150, then $200, if it does, they will already be sitting exactly where they intended to be. Look around. Record highs, structural deficits, bank accumulation, a strained paper market, an approaching Federal Reserve decision, geopolitical tension, all converging, not by coincidence, but by inevitability. Stage 1, the illusion of stability. Stage 2, expansion and debasement. Stage 3, the beginning of crisis. Stage 4, the eruption now loading. You do not need to take my word for any of this. You only need to look at history, because history is not merely repeating, it is rhyming with a clarity we have not seen in decades. I am not a financial advisor. I am simply someone studying the patterns, watching the signals, trying to understand the unfolding story before the world acknowledges it. The silver event is not approaching. It has already begun. The only question left is whether you recognize it or whether, months from now, you look back wishing you had paid closer attention. The choice, as always, is yours. And with December 9 just days away, the clock is already ticking.